banks are now withdrawing credit. Businesses will start going bust. And as the credit withdrawal increases, the chances or the likelihood of banks in other jurisdictions going bust is also going to occur. We have basically financed assets on the back of credit expansion. That is beginning to fail, and when it fails, not only will it affect the real value of those assets, undermining them substantially, but it will also collapse the currencies. That is the end game in what we're seeing.
Welcome back. I'm Nigel Spigel. And right now, if you look just there, you'll see something you rarely see in the wild. A silver Krugerrand and a silver Britannia, available at a very low premium. Right now, silver Britannia and silver Krugerrand are available at just $4.50 over spot. That's a premium lower than my shirt buttons. I just left it in the dryer too long.
That's right, 2022 silver Krugerrand and Britannia, only $4.50 over spot. Call 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We're always privileged to have this returning guest. Alasdair MacLeod is the head of research at GoldMoney.com. He's also a former bank director, and he joins us this Tuesday, August 16th, 2022. Alasdair, thanks for coming back on Liberty and Finance.
That's my pleasure, DK.
If I called you up every time during the week when a client who reaches out to me about gold or silver says, I never miss one of Alasdair's interviews. That man knows so much about the credit markets and about the banking system. And I learn so much every time I watch him. It's like an education. You'd have to get a secretary just to answer the phone from my phone call. So anyway, letting you know that you have a very wide following. You cast a long shadow here. People look to you for the perspective that they're not going to get pretty much anywhere else about what's going on in the internals of the banking world. In fact, that's where I'd like to kick off today, because I've noticed among your copious tweets that you send out during the week, there seems to be a drumbeat of corroboration of the trend and the direction, and basically confirming the growing storm clouds and the evidence that's starting to make itself shown of strains in the credit market, strains in the banking system, and how this is increasingly close to a point where it will not be able to be swept under the rug, but will have real major impact on markets, on our financial lives. So could we start there with what are the things that you're seeing unfolding right now in the world of banking and credit that are of getting your attention and should have all of our concern?
Yeah, it's at the moment it's not all that visible. I mean, people say that they are aware that broad money supply is no longer growing and so on and so forth. But actually, what one's got to understand is that broad money supply is in America, it's something, it's over 90% of credit is bank credit. The rest is currency notes, about half of which, I guess, are not even in America because, foreigners use dollars, if you like, for transactions in their economies, like Argentina and so on and so forth. So you got loads of floating dollars outside America. So let's say 95% of M4, M3, M2, whatever broad money supply measure you use, is actually bank credit. So when you get a contraction of bank credit, basically what happens is you get a contraction of GDP. And that's how the thing ties together. Because GDP is no more than the sum total of transactions in qualifying items, consumer items, for example, done out of bank credit. It's as simple as that. So if you get a contraction of bank credit, then you're going to get contracting GDP. I think it's important to understand this because what is driving the recession, we're talking about some sort of silly idea about 2 successive quarters of contracting GDP as a recession. That sort of rather misses the point. The point is that it's bank credit that is contracting. It's not necessarily you and me spending less, which is what is implied when they talk about a recession. No, it's just that we don't have the bank credit. We're not being offered the bank credit anymore. And on one level, this really is perhaps not noticeable, which is why it takes maybe a little time to come through. By that, what I mean is that, you can spend money on your credit card, and the amount of credit in circulation increases immediately as you do that. And then at the end, when your credit card bill arrives, you should pay it off. Otherwise, you're going to get charged ridiculous rates of interest. If you don't pay it off, then that credit is still outstanding. And most people have a degree of flexibility in their credit arrangements so that they can draw down on credit when they lack, let's say, ready finance. So what you get in terms of the relationship between credit and what's going on in the economy is you do tend to get a little bit of a time lag between what the consumers are doing and it being reflected in overall bank credit. But I think we're sort of getting past that point now. The thing that's driving it, and this is another important point, the thing that's driving it, of course, is that banks are very highly leveraged. It's not such a problem in America. When I look at the asset to equity ratio of the major American banks, we're looking at a figure of around about 10 times. That, to me, is maybe a little rich, but conservatively justifiable. That's okay. The problem comes when you look at banks in other jurisdictions. In the Eurozone, and I think I've said this to your viewers before, in the Eurozone, it's over 20 times. In Japan, it's over 20 times. Now, the reason it got over 20 times is because of negative interest rates. The lending margins just go right down. So if a bank is going to maintain its profits, it's got to up its leverage. And that's what's happened. And I mean, the amazing thing is there's absolutely nothing in the Basel regulations that actually looks at the relationship between total assets and equity. I mean, would you believe it? No, instead, what they look at is balance sheet liquidity, which is a very, very different thing. So we have a situation which, quite frankly, the regulators are just seemingly completely unaware of, which is why it never seems to sort of come out in terms of public knowledge, sort of analyst briefings and things like that. But the fact of the matter is that 20 times leverage is enormous. Now what's happening is you've got a combination of two things. You've got rising interest rates. Rising interest rates improves the lending margins for a commercial bank. So they don't need to be so highly geared in order to get the returns. The second thing is that when you get rising interest rates, then companies and businesses that have borrowed at very low rates on a floating rate, typically overdraft finance, something like that, suddenly become at greater risk of failure. So as far as the bankers are concerned, not only are their margins improving, and we've seen this, a number of results have been announced recently, but at the same time, so is the risk of non-performing loans, as they call it. So what do you do as a banker? Well, the answer basically is you just got to try and cut your balance sheet back as fast as possible. Perhaps trying to maintain some sort of balance between the outstanding assets on your balance sheet, which are generally loans or investments in bonds or whatever it might be. You cut those back as much as possible to the extent that perhaps it doesn't undermine the benefits that you're getting from better lending margins. So you can see that they're playing a little bit of a balancing act here. But if you're going to get your balance sheet back to normal from over 20 times asset to equity leverage, you are going to cut your outstanding bank credit relative to your equity by at least half. Now, this is very serious. You can see that rising interest rates are creating a huge, huge problem in both the Eurozone and also in Japan. And it's from either one or the other that I think we're likely to see a global systemically bank failing. And when you get that, of course, the alarm bells will be ringing everywhere, because we will be seeing the economy, let's go back to what people believe GDP is. The economy going into recession, inflation roaring. I mean, the Bank of England said the other day when it raised its interest rates that it expects to see consumer price index inflation peaking at 13.3% later this year. So you've got interest rates rising, you've got inflation rising, you've got sort of going into recession. I mean, what do banks do? I mean, if they've started on this course of trying to get the risk in their balance sheets under some sort of control, all they can do is accelerate it. So things actually could start developing really quite rapidly. There is another aspect to this, DK, which is perhaps slightly more theoretical, and I hope I can explain it in words which are understandable. Since 1985, there has been a general financialization of Western economies, particularly in American, particularly our economy, and to a lesser extent, perhaps in the Eurozone. But in general, what's happened is that banks have switched their lending activities from lending into Main Street into lending into Wall Street, if I can put it that way. I mean Wall Street in the broader sense. What they have done, I mean, it's an interesting thing that's happened, because what they have done is they have created demand for credit by expanding derivative markets. Now, basically, it means that a foreigner, for example, if he wants to buy a derivative of some sort, let's say a gold future or a over-the-counter gold whatever, or oil or copper or any of these commodities, what he does is he has to buy his dollars, which supports the dollar, and then he buys his derivatives. So you can see that the expansion of the derivatives markets, which at the moment are somewhere in, if you take the combination of OTC derivatives, 610 trillion at the end of last year, plus regulated derivatives such as COMEX and so on and so forth, that's a further 100 trillion roughly. We're looking at about 700 trillion of derivatives extant. Now, they exist because the credit has been manufactured out of thin air by banks in order to provide the dollars to deal in these derivatives. So where does that leave us in this new environment? Well, we've now got an environment of rising interest rates. We've got an environment where we can see that there is a heightened risk of failure in Main Street, ordinary businesses, major corporations, so on and so forth, who don't have the profits to support payments of higher interest rates. And we can also see now that there is an enhanced risk of a banking failure, particularly emanating from outside America, which basically means that the pressure on the Treasury Department of a bank to reduce outstanding bank credit is going to lead to the bank inevitably to start unwinding all that expansion that started in 1985 and ended last year was it earlier this year when the Fed first raised interest rates. So this, I think, is a major, major factor. Now, I mean, I was looking at the price of oil today. It's sort of come off the top, fine, normal consolidation. You've got a growing belief amongst investment managers that actually the inflation problem is going away because we've now got a recession. That means there'll be less demand for, goods, services, whatever. And that means in turn that interest rates can come down because inflation is going to come down. So whoopee, we can hold on to our positions and it'll all be all right. No, I'm afraid not. Because the first thing that happens is, bear in mind that what's driving this is the withdrawal of credit. If credit becomes more scarce, then inevitably interest rates go up, other things being equal. So the first thing that is wrong with that analysis is that interest rates are going to continue to rise from the bank end. Now, how is that countered by central banks? Well, the answer is they've got to stop quantitative tightening, and they will quantitative ease, probably in quantities which heretofore have been completely unimaginable, in order to bolster GDP. So we can see that there are enormous problems on all this. How's this going to work out? Well, the other thing is that with the withdrawal of, or the contraction of all these derivative markets, I mean, forget foreign exchanges, forget all the rest of it, just look at the commodity side. The contraction of that basically means that the suppression of commodity prices through the expansion of derivative markets lessens, and that means that prices will rise. Now, this is going to be a very nasty surprise for everybody who has invested, let us say, in financial assets on the basis that this inflation problem is somehow going to go away. No, it's not. So that, I think, I mean, there are three things that I think I particularly mentioned there, which are important in terms of bank credit. The first is that banks are now withdrawing credit. The consequence of that is that businesses will start going bust. And as the credit withdrawal increases, the chances or the likelihood of banks in other jurisdictions going bust is also going to occur. And the last point, which is the difficult one, I think, for most people to understand, is the effect on derivatives. The contraction of the credit is the reversal of what we've seen between 1985 and 2021. It is a reversal of the factor Triffin dilemma, which has forced foreigners to go and buy dollars to buy derivatives. That is now going to go in reverse. And the currency effect, which I haven't mentioned so far, is that the need to hold dollars by foreigners will be substantially reduced, all other things being equal. So we're likely to see pressure on the dollar in the foreign exchanges, which is only, well, it might not show in the foreign exchanges for some time because the other currencies in the trade weighted are almost in a worse position. But you can see that these flows are going to be quite complex. But the one common thing we will see is the purchasing power of these currencies has only just started to slide. It's going to be a rough and rocky road in terms of how it goes. But at the end of the day, the one thing which I think is absolutely certain is, and I come back to this John Law thing, which I've mentioned on your program so many times, and that is we have basically financed assets on the back of credit expansion. That is beginning to fail. And when it fails, not only will it affect the real value of those assets, undermining them substantially, but it will also collapse the currencies. That is the end game in what we're seeing.
You're right that this is challenging for people who aren't former bank directors to follow in its intricacy, but even in a broad brush, what you're talking about is that everything that has prevailed from 1985 to the current day in a falling interest rate environment, easy credit environment, building up of this huge complex of financial derivatives, which most people have no hope of really understanding, but the net effect of that is that mopped up and soaked up and created a lot of, you could say, artificial demand for both dollars and bank credit. And now the much more rapid, it sounds like, than that long period of 37 years expansion or whatever, will be a contraction that will be less orderly, shall we say, and cause a wash of potential impacts to real businesses because of the unwillingness of banks to extend that easy credit, and also a unwinding by many foreign holders of their derivatives and the dollars that were needed to purchase those. So it sounds like, summarizing it all up, I would say that a derivative collapse destroying currencies is what I'm hearing as the takeaway from that. Is there a different way you would summarize that in a one statement?
No. I mean, that is the eventual outcome if it is allowed to progress. Perhaps I should put it another way. I can't see how it is going to be stopped once it starts. I mean, really, what we've got, it's if you remember back to the Lehman crisis, the problem with letting Lehman go was the effect in derivatives markets, because Lehman was counterparty to quite a lot of derivatives. Now, it wasn't the major player in over-the-counter derivatives. This is why American Insurance Group was rescued, because they created a lot of these derivatives. So that was, I mean, it was securitization. It was the securitization. It was the collapse of liar loans and all that sort of stuff that caught the headlines. But actually, the real problem under there was this mountain of derivatives, how it was going to collapse. And it was really because of that Basel III came out. The G20 gave various instructions to the sort of Bank of International Settlements and so on and so forth, one of which was, never again must governments be saddled with the cost of this. So we're going to do bail-ins, not bailouts. I mean, ridiculous. Anyway, that was one of them. But the other one was that they needed to reduce the amount of outstanding derivatives because when you have an over-the-counter derivative transaction, I mean, typically it might be something like a $20, $30, $40 million transaction. You might have a dozen different counterparties in one credit default swap. And not only that, but the same counterparties come up time and time again, so that you may have an exposure to one counterparty through 100 different credit default swaps. So what the association, ICMA, did was that they came out with rules allowing you to consolidate those outstanding positions to reduce this, the risk, if you like, of a sort of a domino effect if one counterparty arrangement went wrong. So that was done. We now have a situation where derivatives have grown yet again, along with all the credit inflation that we've seen, and straightforward currency inflation too, as banks have been in there doing QE, building up their balance sheet, building up bond positions, and all the rest of it. It is far larger this time than the Lehman crisis, and this time the combination isn't so much property and and liar loans and all the rest of it, and say a derivative problem which nobody really talks about. It's a combination of derivatives and banks who are so highly leveraged as a result of negative interest rates, particularly in the Eurozone and in Japan, that you got the worst of both worlds. It's going to prove, I think, very difficult this time to catch the situation and stop it escalating. It means that forget bail-ins. That's a myth. It basically means that the central banks are going to have to work together in order to save the world, if you like. And it's going to be extremely expensive, and it's going to mean a massive expansion of currency or central bank money as opposed to commercial bank credit in order to keep the system going. And it's that sudden inflation hit that we've yet to see. That is going to be massive and really currency destroying. And it couldn't happen at a worse time. As I said earlier, we've got rising interest rates. Why have we got rising interest rates? We've got rising interest rates because of all the money printing that happened before. And, you can blame the Russians, you can blame supply chain and all the rest of it. But the fact of the matter is that the amount of currency in circulation, currency and credit, has diluted its purchasing power. And that's beginning to work through in terms of what of the prices we pay.
And that's where the first time that most people in their ordinary walk of life become aware of this is when it hits them, directly in their pocketbook, and it's quickly blamed, as you point out there when you were saying, well, you can blame it on this, you can blame it on that. The leaders do, in fact, do that. They blame it on all these factors, and it keeps the man on the street not knowing who to be angry at, that their life has become more difficult to afford our lives. We can't afford to live where we're living. We can't afford to eat what we've been eating. Can't afford to just to be. And Doug Casey puts it that we can't afford our governments, which may be the best summarization of that. I think you echoed, it might have been actually your statement a couple interviews ago when you said we can't afford our governments. It's something that's become a burden on ordinary people. And also when you talked about when the bailout happens this time, it must not be like back in the Lehman crisis where the governments bear the brunt of the bailout. It's like, well, shoot, those governments aren't anything. They're just pass-through entities to the taxpayers. So it's really the ordinary people and their children and their grandchildren that are saddled with these bailouts from this mismanagement of our funds. You mentioned just recently here how this can also be blamed on certain geopolitical events that are going on, and that is also a real thing that's of significant impact to not just prices and availability, but the very stuff of vital supplies, strategic materials, things that are necessary for life. We've talked about Europe is in a particular hotspot right now, not just because of the local conflict going on there in Ukraine, but because there are many geopolitical dynamics swirling around that, some unrelated to that, but all of them are pointing to very precarious situations for vital supplies for Europe looking ahead through this fall and winter. Can you talk to us about what you're watching in terms of geopolitical risks and how those may in fact have dire effects on people around the world, but perhaps starting in Europe?
Yes. Europe, well, let just wind back a little bit. The Ukraine war basically started, in my view, because what Putin wanted to do was he wanted to drive America out of Europe, or drive American influence out of Europe, which basically meant that either NATO had to be restructured or whatever. But the thing that encouraged him to do that in terms of strategic timing was, firstly, Britain, the UK left the European Union, which basically, and we're like that with America when it comes to defense policy, intelligence sharing, and all the rest of it. So the way I've described it in an article which will be published on Thursday is that we are America's vicar in the EU, if you like, vicar on earth, sort of. Anyway. So we have now left. Now, from looking at it from Putin's point of view, he sees that as a diminution of American control over European policy. After we left, of course, NATO came out of Afghanistan precipitously, just abandoned the whole thing. That was another major indicator to Putin that America is on the run. So that, and the fact that all the sort of Middle Eastern wars before, had proved to be considerably more messy than anyone thought when we went into it. It's created great refugee problems. Syria was an absolute disaster as far as the West is concerned. The Ukraine back in 2014 was an absolute mess as well. I mean, that was, just an extraordinarily badly handled situation. So you can see that from Putin's point of view, it was actually quite a good time to try and give pressure on the Europeans to cut themselves off from America in terms of their strategic defense, in terms of the influence, the political and geopolitical influence that America exerts over Europe. And how do you do that? Well, basically what you do is you go and, have a bash at Ukraine again. And he would have expected the reaction from the West, and that was to sanction Russia. He immediately had a response to it and said, well, if that's the way you want it, then you can buy any oil or gas you want, but you're going to have to pay in rubles. And immediately the ruble went from 150 to around about 60, which is the most massive rally in the currency. Interest rates have come down, and so on and so forth. And actually, Russia's trade surplus has risen very substantially. So this is the thing that we need to bear in mind. I mean, we've had lots of people saying, well, you know, Russia's getting into trouble in Crimea now. This is the latest one. You know, they've got logistical problems. They've got untrained army. They're trying to. The mainstream media here is trying to come up with every reason why Putin is failing. He is not failing. He's got cannon fodder. He doesn't actually mind too much. He's got a far bigger scheme which he is interested in. And that is that he wants to get America out of Europe. Then Putin, in association with China, will control virtually the whole of the Eurasian continent. That is his objective. And a few lives here, a few wars here, immaterial. It really doesn't matter. This is a far bigger plan. So what we now have is a situation where, okay, oil prices have come off a little bit, but that's been speculators punting in the market, driving it down. It hasn't been because there's been a sort of suddenly new supplies from somewhere, genuine stock, as it were. No, not at all. So that game's going to come on again, and it could come on really quite quickly. And here is something else that I've discovered in my researches of the relationship between paper currencies and commodities, and that is that you think that the volatility, look at the dollar, for example, you think that the volatility of the oil price is in oil, not the dollars. Not true. The vast majority of the volatility in the oil price is actually from the dollar side. And the proof of this is you just need to look at the price of oil in gold, in legal money, not currency, legal money. And that is, it's gone twice as high since 1950, at the highest in gold, and currently it's 70% of the 1950 price. And where are we in dollars? Dollars, it's gone from 268 or 258 in 1950. The current level, WTI I've got here at 87, having been at 130 or something. Where is the volatility? It is in the paper currencies. And it's very noticeable that the volatility started very shortly after the ending of the Bretton Woods Agreement. Now, what this means is that, and I don't know if Putin realizes this, but what it means is that it's very easy for him to destroy the EU without having to take any further action. If the purchasing power of the euro starts declining again, then the oil price is going to go through the roof, as far as they're concerned, and the gas price, and the price of food, I mean, as you mentioned earlier, and fertilizer, and all the rest of it. So we have got the makings for an enormous economic crisis in the Eurozone this winter, with rationed fuel, rationed food, and I mean, you know, we've all got the food problem. We've all got the oil problem as well, but less so than Europe. And so what Putin is doing is he's putting a squeeze on Europe. And he hasn't lost his objective of getting America out of Europe. No, he's going to just make life even tougher and tougher, you know. Are you ready to give up, Mr. European? I mean, the thing that's fascinating is that in the early days, he was talking to Macron. Macron, who always sort of sees France as being independent of everybody else and a fixer and all the rest of it. Macron has gone quiet since his election, which didn't actually work for him. But I can see that you know, people like Macron and all the rest of it, they'll start jumping up and down and saying, well, we've got to reset the clock. We've got to get the Americans out of here so that we can feed our people. You know, I mean, I can write the script for him. And it won't be too different, even though I don't write the script for him, with what he'll come out with. So you can see that the pressure is going to intensify again on the Eurozone. And it is all part of Putin's desire to take the lead. And I think it is him more than President Xi. I know bigger economy and all the rest of it. But China's got its own crisis at the moment. It's got a property crisis. And if you look at everything to do with property, residential property, the building, the materials, the services, industrial property, and all the rest of it, that is fully 1/3 of the Chinese economy. And that is in a state of collapse. So China has got its problems. As far as Russia is concerned, I mean, it just exports its stuff at higher and higher prices, measured in dollars, measured in euros, and they're really sitting pretty. And I do think that he has been the master of strategy. I mean, I hate to say this of anyone who is anti-West, anti-you and me in a sense, or anti our leaders, but it actually, you've got to give it to him. He's as an evil schemer, he has no parallel. He's even got the Saudis on side. He's even, I mean, Iran, we know. But basically, we in the West, with our woke, non-fossil fuel policies, I mean, I don't know what they're doing in America, but in Europe, they want to get rid of all fossil fuels, basically, in the next 10 years. Cars are all going to be electric. No new cars are going to be produced between, I think, in this country, between 2030 and in most of Europe, 2035. No new, it's all going to be electric. I mean, this is a suicide mission we're on here, doing away with oil and gas and all the rest of it. And we've been caught out. But even worse than that, what Putin's ploy is he turns around to the rest of the world and says, you can have it at a discount. And furthermore, you can pay in your own currency. So that, none of these countries, like India in particular, as a notable example, is interested in following, the sort of Western suppression of trade with Russia. No, not at all. As far as they're concerned, they will take Russian oil, and not only that, but it turns out they're selling it on to America. I mean, this is amazing. I don't know if you saw that, but it's been recorded that a tanker, took Russian oil on board in India, or refined product or whatever, and shipped it over to America. I mean, this is, a leaky ship in more ways than one. But you can see how we are killing ourselves with this climate change, woke agenda and all the rest of it, which is essentially anti-capitalist. Let's be honest about it. While the rest of the world, allied to Russia and China, is going to be given a trading advantage, a manufacturing advantage, a cost advantage, a production advantage, by not having to go through all this rigmarole of trying to get rid of fossil fuels. We're just going to make it available for them. I mean, I can't tell you how stupid the Western leadership have been over this. I mean, we've just killed ourselves. And it's bizarre. It is absolutely bizarre. And when the history books are written, if they're honest, I think students of history will look back on this and say, what were they doing? What were they doing? So all I can say is that as far as Putin is concerned, I think we're going to see the squeeze on Europe intensify, and that doesn't do the banking system in Europe any good either. He's got an exit from this situation. And the switch from banking activity, from financial activities, insofar as banking in the West continues to survive, is going to swing back towards commodities. Why? Because commodity prices will rise, not because they're rising, but as I pointed out earlier with the relationship with the euro, because all of the volatility, in other words, the rise in the prices, is all in the paper currencies. Now, the price of oil doesn't rise in lockstep, say, with the price of natural gas, or the price of copper, or the price of gold, or the price of anything. They all sort of, rise at different rates. But the common theme in it is the volatility is always in the currency. It is not in the commodities. Very important point. Now, if Putin realizes that, then we're toast, or we could be toast. And as I say, China has they've got themselves, I think, into a bit more difficulty because instead of being predominantly an exporter of industrial materials, commodities, and so on and so forth, they are a consumer of these commodities and industrial materials. They will get stuff at preferential prices from Russia, which we won't. They will still be competitive. And in any event, when it comes to trade surpluses and deficits, of course, it is a reflection of what the government's own budget deficit or surplus is. And that's getting worse. I mean, as costs rise, that budget deficit you've got in America is going to get a hell of a lot worse. That is for sure. And unless people save, which they will be discouraged from doing because that's seen as adding to the recession, then you get the twin deficit syndrome. So, this is another problem, if you like, to add to the list in this change, this enormous change in the environment from the financialization, which has supported this sort of huge, great pack of cards, credit cards, pack of credit cards, to one where real things begin to matter a bit more, which is really what it's all about.
That's what I'm keying in on from everything you've just told us about the whole geopolitical theater and the whole scenario playing out is this overall overarching theme that, for example, you've pointed out that Putin is in a power position, but is he primarily in that position because he holds so many real things, real goods, whether it's oil, natural gas, fertilizer, et cetera, things that other countries need, the stuff of life. And it reminds me of our roots in this channel, and you've been interviewing us with us for almost a decade, for where we started out as reluctant preppers and talking about that an individual household needs to have readily available to itself a stockpile of food, water, and things for basic energy protection, that sort of thing. And it's having those real things that's emerging, the waking up from this dream of being able to, you can just invent houses of cards from financial assets that are based on nothing, is what's going to sustain your wealth, to saying, no, it's actually going to be in the coming era, it's going to be those who are holding real things, tangibles, things that have intrinsic value, things that are actually going to support, whether it's at the country level, like Russia, or whether it's at the individual and household level. So that's a main theme that I'm hearing that you're painting for us, that the tide is changing, and we're going to see a collapse and an unwinding and a failure of those things that are based on nothing, thin air, and we're going to instead see the reality reassert itself of the value of real things. Do you want to expand on that, if I'm getting that correctly?
Yes, that's absolutely right. I mean, obviously we need the things we need in life. We need food and we need energy. We need food more than energy, well, depending where you live, really. But certainly you need food, and there's always been a bit of a joke about sort of people thinking, oh, the world's going to end, so I better get some food in and all the rest of it. But I'm sorry to say that it's not quite the joke it was, because an awful lot of people are not going to be able to afford to eat in the style to which they have become accustomed. They're going to have to cut back. And inevitably, these are the people with absolutely no financial cushion whatsoever. And they're going to be caught out. And I'm very sorry to say that. It worries me very much, the effect on society of all these troubles. I mean, Russia went through it after the end of the Soviet Union in 1987 through till, I suppose, 1995 into the Yeltsin years. And it must have been very, very tough. But, I mean, it's particularly tough for citizens in towns who, have to buy everything. If you live in the country, then you've got a chance. You might have, a patch of ground in which you can grow some vegetables or whatever. So whenever this has happened in history, it's been better off to be in the country rather than in towns and cities. I just hope it doesn't come to that, but it's getting more and more difficult for me to see how we can avoid that. I think the other thing I'd like to say is that you've got to think, if you have got wealth, let's say wealth in the form of financial assets, then it makes a lot more sense rather than holding those, because if the currency goes, financial assets are going to go as we know them. I mean, the idea that you've got something listed on a stock market, so that's absolutely fine. If the currency goes, bang, all that basically goes. I mean, it's hard to see how anything priced in a fiat currency can survive the end of a fiat currency. I don't think it'll quite come to that, but I'll come to that in a moment. I think, therefore, that what you need to do is to get out of currency, credit, bank accounts, and all the rest of it, and get into real money. And legal money is gold since Roman times. I mean, J.P. Morgan himself, I think it was for Congress in 1912, said money is gold and the rest is credit. I mean, he wasn't stating an opinion; he was stating a fact. That is still the case, even though governments turn around and try and either stop you owning it or alternatively try and trash its reputation because they want their currency to be seen, if you like, as the real McCoy. It's not the real McCoy at all. So all that, I think, is it sort of militates towards moving out of these financial assets, all tied to fiat currencies, into the safety of real money. So that's something that I would look at very, very carefully. Any of your listeners, viewers, as to how far this collapse goes. I think there does come a point where central banks have no alternative but to stabilize their currencies with some form of convertibility into gold. Now, they may try and get away with saying, they might muck around with CBDCs or something like that, but that's never going to get anywhere anyway. But when it comes to gold, they may not offer proper conversion terms. In other words, I turn up with a $100 bill at my bank and I can cash it in for gold. Now, that might not happen, but something to stabilize the situation by bringing gold back, I think, will happen. And it will happen probably after an enormous slide in the purchasing power of our currencies. I mean, I don't know what the gold position is in America. We know what the official statement is, 8,130 something tons, I think. In this country, we've got 300 and something tons, which is nothing. Canada's got nothing at all. China and Russia have a lot of gold. Russia, I think its official reserves are something like, 2,700 tons or something like that. But they've got other gold, which has been identified, which takes their total holding to around about 12,000 tons. I reckon that the Chinese state has got probably somewhere between 30 and 40,000 tons. The people have got further 20,000 tons. I mean, we're talking about an awful lot of the monetary gold in existence. It's all locked up in Asia and, Asia and Eastern Europe, if you like to put it that way. Halford Mackinder's World Island, we're going back to that sort of concept, which really leaves us in the West in a very precarious position. And I think our currencies are likely to go down very substantially in their purchasing power. And this could be reflected in gold, in a gold price many, many times the current values in all our currencies. What triggers it? I mean, we sit here and we think, well, I'm sure lots of your viewers will think, well, MacLeod's talking his own book because he works for GoldMoney and all the rest of it. But actually, what I'm interested in is sound money. It just so happens that sound money is gold, and gold is legally money, and everything else is credit. So, that's where I stand on that. But I just find it very, very hard to see how we can stop now this John Law experience, which is what we've been doing, what John Law did back in 1720. but at a far larger scale. And his livre went to zero. That tells us where our currencies are likely to go. And I think that there will come a point where the authorities will turn around and surrender, if you like. They'll surrender and admit that they've got to stabilize the situation with gold. What that does to the geopolitical situation is a further question, because it would give enormous power to Russia and China. And this is something, obviously, that the Western alliance will be very, very reluctant to see. And their reluctance to see this, I think, means that they will delay the solution to their collapsing currencies to the last possible moment, all impoverishing us as individuals.
And even worse than delay, in the past, we've seen that when there's anyone who has raised up the possibility of shifting to reliance on gold, there's typically been military might brought against that individual or their country. But when it's the couple of the largest countries in the world that are doing it, and in fact, when the West just doesn't have a significant gold, and if that same playbook is played out again, where the military might is raised up as the club with which to prolong and to forestall that handover of power, that could be a very serious situation for everyone. So we're watching that and with you and concerned about it. I know we're short on time, and I just wanted to give you a chance to let people know how they can follow you going ahead.
Log into GoldMoney, and you'll find there's a research tab. Hit that, and you'll find all my writing under there. We've recently rejigged the website, so my market reports and my Thursday article are all on the same page, as it were. I find in my browser, actually, sometimes I have to click on an article twice in order to get it to show up. I don't know whether that's my browser, but that's where I write. And the article for Thursday is actually about this geopolitical situation and how it all sort of fits together with the banking crisis and so on and so forth. So really, it's pretty much about what we have talked about today. So it might help those who want to understand a bit more about what we've talked about to look out for that article. It'll be up there on Thursday, I suppose, lunchtime to afternoon, this coming Thursday. Yeah. EST, I meant to say.
Right. Yeah, thank you very much for that, Alasdair. And as always, just so grateful for your presence here with us on Liberty and Finance, and look forward to our next visit. Certainly seems that things are coming to a head in multiple fronts, and we're glad to have you in our corner helping us to understand what are the major factors that are behind all of these current events that we keep witnessing. And as always, thanks for joining us.
That's my pleasure, DK.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.